In today's video, we are going to study a situation in the daily chart of the Australian dollar that shows one of the peculiarities of trading with technical analysis. As most of you know, technical analysis is not an exact science, so we need some extra tools derived from broader subjects if we want to fill those important gaps left by technical analysis. You will also see how certain details can save your trades from being stopped out. In the number 1 until the number 3, we can see price creating a lower low, and therefore, showing that sellers have some degree of power over the buyers of this market, at least in the flow that vaguely corresponds to the larger flow in the chart. Beyond the large fractal candle that forms the absolute high in number 2, we also have a slightly smaller flow developing 3 price vectors right after high number 2. This is interesting because we have the larger flow producing a high, and then we have a smaller flow hitting that same high and agreeing about the overall downward direction, forming a similar motion between the flows. Beyond the obvious high number 2 that every trader in the market can observe, we also have an interesting situation in the third vector of the smaller flow, which is where both major and minor flows begin to move in similar motion. Observe that in the origin of the third vector down, we have a fractal candle, and we have a small frequency between two upper tails, including the tail of the fractal candle, of course. This event in an isolated area of the chart wouldn't have much meaning, but the location of this event in this situation tells us a story. Since this is all happening around high number 2, which is the origin of the sellers that ended up in lower number 3, we have indications that a supply zone is sitting right between the two red lines. Let's move on to another level of analysis using the pitchfork so we can understand the peculiarity of this situation. Using the market extremes formed by the numbers 1 to 3, we can create two obvious pitchforks. One is the original standard fork, and the other is the modified one. Right from the start we can see that there is an intersection between two pitchfork lines around number 4, which also happens to be a fractal candle. In a situation like this triple intersection of techniques could be used to trigger a short trade. The correct stop-loss placement is above high number 2 for a logical reason. Number 2 is the birthplace of the sellers that created the vector from number 2 to number 3, and this is one of the vectors used to draw the two opposing pitchforks in the first place. However, by looking at what happened after number 4, we can spot a problem. Even though that entry is certainly valid, we can observe that price does not fall immediately, and a minor flow upwards continues to develop until number 5, which is the supply zone that was identified earlier by observing the absolute high number 2, and the moment where the minor flow began to move in similar motion to the downside with the major. If you triggered a short trade in number 4, at this point you would begin to worry about your analysis. There is another hidden detail here lurking in the pitchforks, which is the duplication of the modified one to possibly find an intersection with the supply zone. By grabbing the modified fork and duplicating it to the upside, we can see that its upper line intersects with the upper tails around number 5, which are very near the supply zone that comes out of number 2. Another piece of evidence that would indicate to the downside in here is the famous Hagopian's rule that is associated with pitchforks. This rule simply means that if price fails to reach one line of the fork, it tends to create a large movement in the other direction. If we observe price around number 5 in relation to the center line of the blue pitchfork, we will see that number 5 is a possible representation of the Hagopian's rule, and we could expect a strong movement to the downside. Number 5 is the last chance to make this short trade work without triggering the logical stop-loss order, so let's see what price did after number 5, and then we will make final comments about the whole situation. Here you can see that buyers were able to climb until the very last barrier created by sellers before passing the control of the market. This is the perfect situation for you to understand the importance of a correctly placed stop-loss order. Even when you get your entry a bit wrong, which sometimes is inevitable, the correct stop-loss order will allow you to continue in the trade and take advantage of the situation. All you have to do in a situation like this is to have the discipline to not give up on the trade, and maintain your orders exactly where you planned. If you move your stop loss, for example, you will mess everything about the trade, and it's simply not going to work. Hopefully you were able to learn something new with this video. If you are interested in learning how to trade like this, please check out the Fractal Flow courses available in the Strategy Store in the link in the video description. If you like these videos, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button so you don't miss future uploads, and by leaving your feedback below in the comment section. Thank you for watching.